Now we will be looking at the balance sheet and the P&L, and based upon this balance sheet and P&L we will try to evaluate different ratios. So the balance sheet data is given here and the P&L data, or what we call as income statement, is given here. Now let's start to understand the gross profit margin first. So basically gross profit margin is what? It simply tells you that how much you are earning from your routine operational methods income. So basically it simply says you take your net sales and you reduce from that net sales your cost of goods sold, that cost which has been incurred for production of those goods, and finally you divide it by your net sales. Okay, if we see our P&L here, this is our income statement. Within this income statement, in the current year we are having a sales of $400 and our cost of goods sold is $250. So if someone asks you what is your gross profit, so you will be saying $150 is my gross profit, and this gross profit is being earned on a sales revenue of $400. So simply you will be saying this $150 is earned on a sales revenue of $400, giving your gross profit as 37.5%. Now why this gross profit is important for you and anybody else? So simply the gross profit tells the Apple company that for every dollar of sales, this is like every dollar of sales, the company or Apple company keeps $0.375 effectively. So when it's 37.5%, it means for every, because in the denominator the sales is given and in the numerator the number is given. So for every, I can say, revenue, the denominator is 0.375, is like for every 1 rupee of revenue the gross profit is 37.5% or 0.375. So basically it earns it after paying the cost of materials and manufacturing. So only cost of materials, direct costs which are incurred for the product, is being looked upon. Company can also see and use it to compare performance over time, that if margin drops from 37.5% to 30% in the next year, company knows that there are two drivers to it, that why your margins are reducing. So company simply knows that your margins is the function of either your sales or your cost. So simply there may be two reasons: either your costs are increasing or your pricing is under pressure, which means that your pricing may have the impact of people are not accepting the price and you are offering higher discounts. The third thing is like you can compare and benchmark with other companies, that what is the gross profit of Samsung, what is the gross profit of Dell, and what is the Apple's gross profit, and based on that you can determine how good you are performing compared to your competitors. And similarly other strategic decisions can also be made, just like whether we need to increase the price, reduce the cost, and focus on higher margin products like MacBook versus lower margin products. And finally, investors are also required these things to analyze the operational efficiencies and to understand how they should be going about it.